Miriam, consumer spending accounts for 68% of the economy.
Yes, and our guest this week essentially says that what matters most for those consumers is being employed and having wages that grow faster than inflation.
He gets into that and what we should expect for this upcoming jobs report. We'll get to that in a bit. Hey, everyone. I'm Telis Demos. I write for the Wall Street Journal's Heard on the Street, and this is WSJ's Take on the Week, the weekly show where we give you a leg up on the worlds of money and investing. Each week, we bring you conversations with insiders and from inside the Wall Street Journal's newsroom about stocks, bonds, public investments, private investments, crypto, and everything in between. And once again, I am joined by Miriam Gottfried. She is, once again, filling in for Gunjan Banerjee while she is away. Thanks, Miriam, for joining us once again.
It's great to be here.
You're a regular here.
I feel right at home.
Feel right at home. Well, we feel at home with you here. Well, Miriam, we took a little break from talking about tariffs last week, but we're back again now talking about the thing that it seems like the markets move on every single day, which is President Trump's tariff policy. And this upcoming week, there is a big day. April 3rd is now going to be the day when President Trump will levy 25% tariffs on all imported autos and, the latest reporting suggests, also auto parts.
And that's Liberation Day, right? That's
President
what he's
Trump
calling
is calling
it.
that Liberation Day. There may or may not also be some things happening on April 2nd. That was originally the day President Trump had laid out for when they were going to start implementing or at least announcing the reciprocal tariffs. These were things meant to combat specific kind of trade inequalities that the administration had identified. Scott Bessent called these countries the Dirty 15. These are the 15 countries with the biggest trade imbalances with the U.S. It seems like, again, the Wall Street Journal's latest reporting as of this recording is that those measures aren't going to be quite as dramatic as
They're not
going
to bring them into parity, which was originally the plan. So it might be a bit of a lower tariff than originally planned, is what we're hearing.
Okay. So what does this all mean, though, for what the market is going to think about tariffs? Like, are we now at the end of the road and the market can just sort of go forward with, okay, this is the policy? Do we have that clarity yet?
I don't know. I mean, stocks seem to have leveled out, but I think it's really hard to know how tariffs translate into corporate profits. And, we're going to have earnings season kicking off soon for a lot of companies. And I think we'll start to see whether the reality of tariffs is different from the expectation of tariffs and whether the market properly priced these risks.
And tariffs also have challenges about implementation, right? So, for example, I mentioned that they're going to be the auto tariffs would apply to both imported autos potentially and auto parts because, what is a car other than parts, right? If it's just on imported cars, well, if you take the car apart and put it in pieces, is that then still a car? So, there are questions about exactly how these things will be implemented that may still be yet to play out, which I guess on the one hand means that there's still perhaps uncertainty. On the other hand, it also means that it's really unclear what this might mean for the next quarter or even the next year's earnings for auto companies or anyone else in that business.
And there's always the chance that these won't last that long, which is what people have been hoping or expecting from the beginning. Maybe this is just a temporary situation, so we don't know.
I think it's worth also listening to what the bond market is telling us. We have seen a pretty substantial decrease in long-term U.S. Treasury yields. And one thing that means is that investors are expecting slower growth in the at some point in the future. And so it seems like perhaps whatever tariff policies are, the expectation seems to be growing that there will be some, kind of pause at least in growth at some point from just the uncertainty that maybe all those things will weigh on corporate decision making. We talked last week about investment banks and the way that they're approaching their business. And we are seeing signs that the companies have paused big projects and new investments and things like that.
But then again, Telis, on the other hand, one way you can see what the market is thinking is through the IPO market. And you need a lot of confidence, in the stability of the market in order to go out on a roadshow and launch an IPO. And we are seeing a number of IPOs coming up soon in the coming weeks. CoreWeave went public. They are an AI cloud provider, big AI play. And basically what they do is they own chips and they lease them out to other people. So this is a big bet on the value of NVIDIA chips.
Yeah, I think we can upgrade the IPO market from dead to merely moribund or mostly dead.
I don't know. We're getting a lot of names here. We're getting a lot of names. We got Klarna.
They're names people know.
StubHub. eToro, which is a Robinhood-like company. Newsmax. So these are kind of household names in a lot of ways.
Yeah, and I think, obviously how those IPOs perform will be part of the read that we get on, sort of market confidence and market expectations. But just launching deals is a sign that people are getting over, they're just getting used to the fact that this is the way things are going to be. You've got to sort of make do and kind of move forward. So I think I think the way Wall Street thinks about it is that just seeing IPOs starting to happen, and unless they go horrifically bad, it probably will mean that more deals are to come. One thing I think that will continue to sort of set the tone in the market is what we are seeing in economic data. Because, we've been talking about this R word, even the S.
We can't even say it.
We can't even say it. That's right. Our former editor, who now WSJ columnist, Spencer Jacob, recently compared sort of recession talk to the way that they treat Voldemort, the Harry Potter character, whose name you're not even supposed to say.
He who shall not be named.
Recessions. People are saying it. Recession, recession, recession. There's always the risk, I think, that we... And as Spencer put it, we talk ourselves into a recession, that by thinking that a recession is going to happen, as we've been saying, people make decisions that then lead us into recession, right, because they're afraid of it. So they sort of bring it about. There was a recent survey, Deutsche Bank surveyed fund managers, and they said 43% of them now expect a recession. That being said, I will say that the data that we have been seeing this past week has not necessarily been recessionary, right? I think we've seen, we had for example, the S&P Global Flash U.S. Composite PMI, which is a very fancy way of saying sort of activity in the manufacturing and services sector, showed services activity accelerating, right? Likewise, durable goods orders, what that data showed was that a lot of companies are actually buying stuff ahead of tariffs, perhaps. They want to get the prices today rather than what the prices might be in the future. And so that activity is picking up as well. And it all paints a picture of an economy where people are certainly making decisions maybe out of concern, right? They're sort of stocking up or doing things ahead of what they think might be turbulence. However, while gloomy, the data is not necessarily recessionary. And
on the one hand, you have sentiment being kind of gloomy and, worried, concerned, but the data doesn't back up that gloom.
It's the vibes. Vibes. But one thing that I think people really, really, really want to know about, forget all these indicators we've been talking about, here's the one that maybe matters the most, and that is what is happening in the labor market, jobs, employment. The employment number, the unemployment number is coming out next week. We're going to have the monthly jobs payroll report. And our guest is going to talk about what we are looking for in that report, what it might tell us, and why this is such a vital, important indicator.
That's right, Telis. We had a conversation with Bank of America economist Aditya Bhave about what the state of the labor force can tell us about the greater economy and what to look out for in this week's jobs report.
I'm excited about this one. The jobs report is both important and mysterious. Aditya is the senior U.S. economist for the bank's investment banking arm, BofA Securities. And we'll get to that conversation right after the break. Today, we are joined by Aditya Bhave. He is the senior U.S. economist at BofA Securities. Aditya, welcome.
Thank you for having me.
So, this upcoming week, we are going to get the next official hard numbers read on the U.S. labor market, the jobs report on April 4th. What will you be looking for out of this particular report?
We think it'll probably be a pretty solid print. The best leading indicator for monthly jobs growth is jobless claims for the corresponding survey week. That was, very sort of acceptable, right, around 220,000. And we've been around 220,000 for several weeks now. Yeah. So it looks like another solid month of job growth. There may also be some favorable weather patterns, at least relative to January and February. in leisure and hospitality. That should help hiring in that sector as well. A little bit of concern about federal job losses. The numbers still look somewhat small, but that is one thing that we'll definitely be watching for. Another thing we'll be watching for is the unemployment rate. So that went from 4% to almost rounding up to 4.2. It was 4.1% in February. I think if that continues to tick up, that would be quite concerning for the Fed.
Is that a big jump? I mean, it doesn't sound like much, but is that actually like kind of a large increase?
For 1 month, it's fine. But if you continue on that trend for 2 or 3 more months, then it gets more concerning.
And what might be driving that? Is it the things that we're all talking about now? Is it tariffs and other Trump economic policies? Or are there other kind of forces that are happening in the background? Because, as we've talked about before on the show, tariffs have sort of started, but not really. Yeah. So it can't exactly be that, right?
Right. So the unemployment rate is based on the household survey. That is much noisier than the establishment survey from which you get non-farm payrolls. So again, if it's just a 1 month jump, I wouldn't really worry about it. There have been some pretty favorable household surveys in the previous months.
Okay.
I'd just keep an eye on it. If we can come up with a story and say maybe it's this or that, if it continues for a couple more months, and if it does, then I think it would also be reflected in the establishment survey, which hasn't happened so far.
So when companies are laying people off, when the non-government employment is not growing, is that telling you that companies are in trouble? Like, is that a sell signal for stocks because companies are laying people off? Or could there be kind of positive things baked in there from the point of view of like corporate earnings? Are companies getting more efficient so they can do more with the smaller labor force? I mean, obviously we talk about the impact of AI, right? That's not for workers, but for companies. The dream is that they can do more with less in terms of employees.
So elevated layoffs in the short term, at least, usually correspond to a downturn. You can think about kind of medium-term, longer-term effects where that can lead to higher efficiency and so on. What's been really impressive about the cycle, and I think that's part of the story of consumer resilience, is that the layoff rate has been very, very low. Hiring has dropped, and that's partly why the labor market has cooled off, but we're kind of in this low hire but very low fire environment, and we've held there for an extended period.
And if we continue to hold, what does that mean for the Federal Reserve's next move?
Our view is that the Fed probably won't end up cutting again. Basically, activity is a little bit too strong and inflation is a little bit too elevated, right? So if you think about their 2 mandates, we don't see a compelling case to cut, and we also don't see a lot of leeway to cut.
Those 2 mandates being, on the one hand, to look at to run the economy at full employment, like you said. The other one being to control inflation. And it was interesting what you wrote in your most recent note. You said that the Fed has some leeway on the full employment mandate, but no margin for error on its inflation mandate.
Yep.
So you're saying that the risks are more towards inflation going up significantly than they are to unemployment spiking up.
Well, so what we were trying to say there was that activity is running, depending on what you look at. If you look at GDP growth, it's running above trend. If you look at the labor market, the unemployment rate, it's around where they would like it to be in terms of full employment. But then if you look at inflation, that's actually above target already. The way we've been talking about this, I mean, the risk that everyone is talking about now is stagflation. Right?
Wow. We talked about the R word last week. We're getting to the S word now.
Yeah. So our view is that this concern is a little bit overstated.
Okay,
it's going to be a very mild case of stagflation. But stagflation is the most difficult thing.
Is that good? Is that like saying like a mild case of bubonic plague?
No. It's like a mild case of the flu. Let's say. It's really not that bad. Okay. So the way we think about stagflation, though, is that it's kind of like when your kids run in opposite directions, and then you have to decide which one to chase, right? If you're the Fed.
Because stagflation is like this special mix
of softer activity, which might make you want to cut,
right?
But then higher inflation, which makes it much harder to cut rates. Right. I don't think hikes are really in the conversation for now, so we can set
the
that
1970s
aside.
Were famous for their
the
stagflation.
The 1970s were a really extreme version of stagflation, early 80s as well. This is nothing like that from our perspective. But, if you go back to where does the Fed have leeway, the kid that's maybe running towards danger is inflation. right? So from our perspective, that's the one that the Fed has to be a little bit more cautious about. And that's why we think it's difficult for them to cut rates from here.
I know you're an economist, not a market strategist, but from an investor's point of view, what does stagflation kind of mean for companies and investors? Because, like you said, you've got growth is slowing, but inflation means that prices are rising. But generally speaking, what does that mean for the investor side of things?
It's typically not great for markets. Again, degrees matter a lot here. I think a lot of negativity has already been priced into markets, perhaps a bit too much from our perspective. So if you look at our forecasts, we've marked down growth a little bit, but we still have 1.5% growth for the first half of this year, which is very close to where the Fed thinks trend growth is. And then we think we rebound to 2% in the second half when the focus shifts from trade policy to fiscal policy and maybe the potential for corporate tax cuts.
When we look forward, we see a lot of things coming out of Washington that seem like they will be very impactful for the job market and, of course, for the economy broadly.
Yep.
What are kind of Trump 2.0 policies that you think could be impactful for the job market? I mean, let's start with DOGE, the Department of Government Efficiency. They've been trying to cut a lot of jobs in the federal workforce. What does that all mean for employment? Are those things we're going to see in jobs reports coming up?
So I'd focus separately on the direct impact and the knock-on effects.
Okay.
The direct impact is likely to be somewhat small because total federal employment is less than 2% of non-farm payrolls. So it's going to be a regional shock.
Yeah.
And we're already seeing some indications of that in our internal card data.
In the D.C. area.
In the D.C. area, the D.C. metro area. But does that turn into a national shock? We're skeptical because the region is not large enough to affect the macroeconomy.
Okay.
However, there are some concerns about knock-on effects on hiring of contractors, hiring in research, healthcare, education, maybe because some grants have been pulled back and so on. We're not seeing those effects yet, but that is going to be something really important to watch for in upcoming jobs reports, including the next one.
And what about immigration policy? Obviously, there's an effort to deport people who are, deemed to be here inappropriately or illegally or otherwise. What impact is that going to have? I mean, I think we've had a lot of guests come on and talk about that being a meaningful part of the labor supply in the U.S. What are you looking for there?
Yeah, so that's actually another interesting aspect of the jobs reports, right? So non-farm payrolls could slow just because of slowing immigration flows, but the unemployment rate could remain somewhat low. Right, so
because you have the numerator and the denominator.
Exactly,
there, right? Okay.
Exactly. So it would be a case of labor supply potentially slowing, maybe even faster than labor demand, which could actually tighten the labor market.
So the headline unemployment rate is 4.1% as of February, and there's a pretty common critique of the unemployment report that this number isn't really inclusive of people who are marginally working or have left the labor force because they've given up. And some say that the actual unemployment number is closer to 7%. Others say it's even like 25%. What do you think about that, and what's the number that we should actually care about?
So 25% is definitely an interesting number that I haven't heard before. I think what you're referring to is the U6 rate, which is the underemployment rate, and that includes folks who are called, marginally attached to the labor force in the sense that they're not actively looking for jobs, but they would like to have a job.
They would kind of like to have a job.
Yeah, and also people who classify themselves as part-time for economic reasons, meaning that they have part-time work, but they would prefer to have full-time employment. That component increased a lot as of February, and I think that's probably where you're going with this. And so the U6 underemployment rate went up to 8%.
And just for the geeks, it's
yeah.
U3 that we usually talk about.
U3
right?
is what we usually talk about.
That's the 4.1% rate that we're talking about now. Okay.
And you want to look at both of these indicators relative to their historical trend. So 8% relative to trend for the U6, it's not terrible.
Okay.
But there was a pretty sharp increase in February.
From what to what?
I believe it was from 7.5 to 8%.
Okay.
So it was a big jump. And basically all of it was because of these folks who are part-time for economic reasons. Mm-hmm. So why did that happen? Again, it's a noisy data set. We'll have to see if it just gets paid back next month. But to the extent that, folks who lost their jobs are, instead of being completely unemployed, they're working in gig jobs, for example, part-time gig jobs, that's still better than the alternative of being unemployed, right? So I wouldn't kind of fully take that critique on board. Yes, we don't capture gig economy workers in the unemployment rate, but being part-time employed is still better for them and for the economy than being unemployed.
Yeah.
So how important is it to pay attention to real wages and other real economic data? Because obviously we all talk about inflation. We're worried about the impact of tariffs on inflation. We look at what's happening with eggs, right? All of those things, do those things really matter if people's incomes are rising faster than that? Or is there some problem with inflation even if people's incomes are rising faster than that?
So the general view in the economics community is that when inflation is elevated, it causes two problems. The first one is that it eats into real income growth. And that can obviously be offset if wages are keeping up with inflation. The other problem is that it creates uncertainty. When inflation's running around 2%, as Powell says, it's rational inattention, right? You just don't pay attention to it and you move on with your life. And that's the way corporates like it, and that's the way consumers like it. Consumers do not like planning their finances.
Because they're worried that if prices go up in the future, that they just aren't going to want to spend.
Right.
Prices could go up. I'm just going to save my money.
Or they spend more now because they're worried prices will go up in the future.
Exactly. But it's just the sort of decision making that people don't like to do.
Yeah.
Right. There's also the concern.
So what happens? They just don't spend, or
presumably they spend less.
Okay.
There's also over time, right?
Mm-hmm.
There's also a concern of you don't know which prices are up, which prices are down. When inflation's running at 5%, you go to the grocery store. Eggs might be up 10%. Bread might be flat. So now do I eat more bread and less eggs, or whatever? Right. These are just unpleasant decisions.
Yeah.
So lower inflation overcomes all of that unpleasantness, but certainly, stepping back, if real wage growth continues, then the consumer will probably be okay. In fact, our view for a while with the consumer is kind of pay them and they'll spend. The other stuff that gets a lot more focus, consumer sentiment, balance sheets, and so on, from our perspective, matters a little bit less, maybe because the starting point for balance sheets is so strong. But it's really real income growth that is going to determine the trajectory of the consumer, and the consumer is 68% of the economy. So that will probably determine the trajectory of the economy as well.
That's interesting. We're going to take one more break, and when we come back, we've got one final question for Aditya Bhave of BofA Securities.
All right, Aditya, in 30 seconds or less, do you think the unemployment rate could go back to 5% before the end of the year? And remember, we're at 4.1% as of February.
Can I answer that in 5 seconds?
Sure.
I think it's unlikely. No, I mean, more seriously, it would require a recession for that to happen. Several things would have to go wrong. There are some upside risks to the unemployment rate, but we just don't see that loss in labor momentum right now or pick up in layoffs, especially in an environment where businesses should also be thinking about potentially, ramping up CapEx later this year as potentially full expensing of CapEx comes back, right?
Thank you.
Thanks for having me.
Thanks for joining us.
Thanks.
We still say from the 90s, it's the economy, stupid. Maybe we should say it's the jobs market, stupid.